Conversation Forward, Head of Equities with DSP Mutual Fund. Vinit, good morning. Thank you for joining us. Uh, Looks like a shaky and a scary world, whichever way I look at it. Half the world is worried about recession, half the world is worried about inflation, everybody is worried about currency, and nobody seems to be talking about how the bond yields have shot up in India. What are we staring at? Are we staring at bad getting worse before it gets better?
So, Nikunj, good morning. I think these are all very valid concerns, but also please remember that we need some of these worries for the long-term investors to actually plan his investment quite well. Otherwise, in a linear bull market, it becomes very difficult to look at investment from a long-term perspective. So, I would say that while we are also a bit cautious in terms of the valuations at which the markets are trading today. Given the world is disorderly, there are a lot of these concerns, and I surely feel that India cannot remain decoupled from all these global issues, be it inflation, recession, interest rates. Definitely, when one is thinking of higher interest rates in the economy, it is very obvious that the equity valuations need to actually sort of consolidate or start looking at some bit of discount. So I think from that perspective, when we look at higher valuation, specifically in relation to the markets, also specifically in relation to some of the sectors, it actually raises in our minds also some bit of caution. And we hope that in the let's say ensuing disorderly changes or volatility, this would create its own opportunity, because what we are frankly thinking about is this is a beautiful juncture today when we are looking at growth, we are looking at government's reforms which are actually I would say very timely in nature and should actually lead to good recovery, economic recovery over the next few years. And anyways, post COVID, we are at the lows in terms of the economic recovery. So I would say that it's a good combination to have, wherein some of these volatility would create its natural, let's say, opportunity set for the long-term investors.
Now, I'm just looking at the list of your buys and sells, recent ones, Vineet, and please correct me if I'm wrong here. Is ICICI Bank a sell now, and why so? Is it the overbought consensus which is making you a little wary, or do you see money moving out of ICICI Bank to perhaps some other names as part of the rotation within banks?
So broadly, I think we have been generally quite positive on the banking sector for a while, and we played. If you look at our portfolios, ICICI Bank has been one of the top weights for us in terms of the outperformance. There were some, let's say, trimming which we might have done, but those are more linked to our, exposure limits which we have in each of the portfolios, not necessarily linked to our views on the bank. We can't continue to hold positive view. Just that, when we also think of relatively shifting from one to the other, it is possible that on a risk reward basis, when the valuations for one actually goes past, the normal range, and we see that some of the other banks might be trading at decent valuation, there are some marginal changes which we might also look at. But broadly, I think we continue to hold a positive view. I think the stance continues where, the banks, we believe, would be a big beneficiary of the economic recovery after a while. The growth is coming back, and the balance sheets are pretty clean for the banks to actually keep thinking of a robust growth going forward.
Urban consumption, as I see, continues to be a popular theme. Both the likes of a Jubilant Foodworks and Phoenix Mills are the new entrants.
We've been actually owning those names for a while, and we believe, like I said, while these segments are pretty expensive as well when we look at the valuations, but given the long runway of growth available for consumer discretionary, we like these names. And anyways, I think in the current environment, we've seen that some of the urban related spends are doing well, and that is helping some of these names. And when we also think about each of these companies' plans for growth, when they are announcing new opening of stores. They have really decent plans, which actually also gives us confidence that there is one decent opportunity. People are spending more on some of these activities, and these are going to lead to good runway for growth available over a longer term.
Vinith, hi, morning. The IT sector as well, what's the outlook there? Because, we seem to have a consensus that the high-tech intensity going forward is going to be a huge beneficiary. There are some mid-cap IT names as well on the radar.
Yeah, so see, actually, IT has gone through one big cycle wherein we've seen that the growth was very robust post COVID. The margins, the companies benefited because of the low cost environment, and now some of that seems to be reversing when we look at the recessionary slowdown related risk. When we look at the cost actually coming back up and margins getting depressed a bit. But that also is creating some bit of valuation comfort. In the past, we've seen the valuation also actually soaring to record highs. Now, the valuations are moderating, and we believe that given our view that the long-term outlook for the IT sector, is pretty strong. We've actually, mapped the growth for the IT sector for the last many years. Even in case of a slowing global economies, there was a positive. I mean, the IT sector has not recorded negative any year of negative growth. So I think while the growth rates may slow, but the opportunity set, our company's strength and competitiveness, that will make sure that these companies will continue to grow. Just at what price point or at what valuations one would like to sort of look at these names is something to think about. So frankly, for us, the next, let's say 6 months, when we go through some of these recessionary trends and the global world slows, I think those will keep providing, let's say, good opportunity for one to look at the IT sector.
Last time when markets fell, and I'm using not once upon a time here, not COVID, I'm talking about May, June, early part of July. That time, tech came down and energy stocks went higher. Right now, energy stocks are down, IT is down. 3 months ago, world was worried about inflation. Now, world is worried about recession. High inflation is a decent thing to have for markets because markets like a little bit of inflation. But when the word recession comes back, it's bad for everybody. Has the template of the market changed? Because the fall in terms of the differentiation, I think, is very, very different. The whole premise is different. Let me put it this way.
So, as I said, Nikunj, it is a very complex world right now. When we talk about recession, what we are also hearing across some of the sectors, like, we spoke to the tile companies, what they are saying is that the exports is really picking up because globally the cost of manufacturing is much, much higher given the high energy prices. So, probably this year may be one of the, best years for the tile export business. Likewise, we see that in some of the specialty chemical value chain, because the Europe is actually, looking down in terms of the business, or the cost matrix is leading to shutdown of manufacturing. There are opportunities which are actually coming up for Indian players. Likewise, even in case of IT, it is possible that due to the cost takeout, decision which the companies take there, is it going to benefit the outsourcing? I mean, these are something which we'll have to watch as they play out. That is number one. Number two, the point is that, let's say we compare it with the COVID world. What was happening in the COVID world was the demand was high and the supplies got restricted because of the supply crunch. And that was the reason for inflation, and which now, through time, we've seen that, inflationary pressures have only risen, which is now leading to quantitative tightening and all of that, which is a cause of recession. 6 months forward, as large economies, US, China, they face slowdown, what's going to happen is that the demand is going to slow, and there is a repair which is going on as far as the supply chain is concerned. I mean, people are building pipelines, people are making sure that, they are not again hit by these supply chain bottlenecks. So probably 6 months down the line, things can be very different where, there is a good supply and the demand is low, and then the reason for inflation may not remain. So I think the world is going to change very fast, very quickly. It's going to be very difficult to decipher. I think the best way is to look at categories and segments which have achieved good global scale competitiveness, valuations are okay, and just remain invested and try to just go through the volatility, because volatility is something which one will have to live with over the next few months, I believe.
Put in a very bullish ingredient in the melting pot, so to speak. We can talk about inflation, recession, bond yields, commodity prices, FI selling. We are discussing it publicly. What we're discussing on television forums is something markets must have figured it out early. How come markets are not reacting to the fact that crude is down? Demand has started coming down. US exports have started falling. How come markets are not paying attention to the fact that sooner than later inflation and commodity prices have peaked out and inflation has to come down, and it is time to, let's say, buy commodity consumers. It is time to buy companies which will benefit because of decline in commodity prices, because whether it's Diwali or Dussehra or Christmas or New Year, I don't know, but my friend, prices are going to come down.
No, I think and you're right, and we've seen that happening. Let's say auto sector last 3-4 months has outperformed quite a bit, and one of the reasons for that was some marginal uptick which we once saw in the demand environment. But at the other end, there was this commodity which was also one of the driver, the commodity fall, because that would mean that the margins for that category should start doing well, and that was getting built in terms of the numbers optimism that was seen. So I think gradually, as the visibility of some of these trends improve, I think that will start getting reflected in terms of the market changes as well.
Vinit, you had spoken about how the auto sector is likely to be one of the strong overarching themes for the long haul. Do you believe that one needs to have a mix of good auto ancillary companies, auto OEs in the portfolio?
Yeah, definitely, I think if you look at the auto numbers, they are at decadal lows. I mean, what one had seen in 2012 is what one is seeing now in terms of FY22 numbers broadly. As we believe there would be cyclical recovery on the auto front, and I think globally as well, the world is facing these challenges, but the auto cycle is at the lows. So it is good to look at some of these segments when the business cycle is at the lows, because as the cycle turns over the next 2 or 3 years, the demand is going to sort of come back. There is going to be need for vehicles, replacement demand will be there, new demand will be there. So I think all of that will mean that the segment actually does well over the next cycle. Just that one needs to be a bit careful as well, because there is this whole transition of technology which is happening. Electric vehicles are catching momentum. So one will have to keep that in mind while assessing various businesses, to make sure that businesses are not going to get disrupted over the next few years.
Okay, Vinit, so just to wrap it up, with some final thoughts. 6 months from now, if you will look at October 2022, the time when global markets in a sense were slightly stormy, 6 months from now, a year from now, for those who bought this fall, they will be happy, or for those who sat on cash, they will be excited?
My thought has
Don't dodge this time. Don't dodge this time. Please don't tell me the advantage of staying fully invested.
No, I would say that one should remain invested. And let's say 6 months from now, exactly on that date, if one is unhappy, then I would say please extend your time horizon. It is going to be a good journey for the next 2 to 3 years. I mean, there could be one-off events which will keep hurting or impacting the markets, but I think one has to stay invested in equities. This is a good time over the next 4-5 years, I believe.
It's such a pleasure having you on the show today. We'll let you go on that note. Good speaking with you.
Thank you.